Financial planning for small business owners is a crucial aspect of managing a successful enterprise. Proper financial planning helps entrepreneurs to make informed decisions, allocate resources effectively, and achieve their business objectives. Here are some key components and considerations for financial planning. Budgeting. Creating a budget is fundamental to financial planning. It involves estimating both revenue and expenses for a specific period, typically on a monthly or annual basis. A well-prepared budget helps in tracking cash flow, identifying potential cost savings, and ensuring that the business stays financially stable. Cash flow management is one of the most critical aspects of financial planning for small businesses. It involves carefully monitoring and controlling the movement of money in and out of the business to maintain sufficient liquidity and meet financial obligations. Here are some key points to consider when managing cash flow. Cash flow forecasting. Creating a cash flow forecast helps in predicting future cash inflows and outflows. It typically covers a specific period, like a month or a quarter. By estimating future cash flow, business owners can identify potential cash shortages and take proactive measures to address them. Invoice management. Promptly send out invoices to customers and clients for goods or services provided. Offer clear payment terms and follow up on overdue payments. Delayed payments can significantly impact cash flow, so it's essential to establish an efficient invoicing process. Accounts receivable. Keep a close eye on accounts receivable, which represents the money owed to the business by customers. Implement effective credit control policies to minimize overdue accounts and encourage timely payments. Accounts payable. Manage accounts payable carefully by negotiating favorable payment terms with suppliers. Aim to extend payment deadlines without damaging relationships. However, always ensure that you pay within the agreed-upon terms to maintain good credit with suppliers. Controlling expenses. Regularly review expenses to identify areas where costs can be reduced or optimized. Look for cost-saving opportunities without compromising the quality of products or services. Inventory management. For businesses dealing with physical products, optimizing inventory levels is crucial. Stocking excessive inventory ties up cash, while insufficient inventory may lead to missed sales opportunities. Adopt an efficient inventory management system to strike the right balance. Emergency reserve. Maintain a reserve fund to handle unexpected expenses or emergencies. Having a safety net ensures that the business can continue to operate smoothly during challenging times. Debt management. If the business carries debt, manage it responsibly. Focus on paying off high-interest debts first and consider refinancing options if lower interest rates are available. Seasonal variations. If the business experiences seasonal fluctuations in revenue, plan accordingly. During peak seasons, save excess cash to cover expenses during slower periods. Cash flow analysis. Regularly analyze cash flow reports to gain insights into trends and patterns. This analysis helps in making informed decisions and adjusting the business strategy when necessary. Emergency fund. Small business owners should establish an emergency fund to protect their business during tough times. This reserve can be used to cover expenses during slow periods, emergencies, or unexpected financial challenges. Debt management. If the business has taken on debt, it is essential to manage it prudently. This includes making timely payments, negotiating favorable terms with creditors, and avoiding unnecessary high-interest loans. Investment decisions. Small business owners may have surplus funds that can be invested. It's important to carefully consider investment opportunities, balancing potential returns with risk. Investments can be in the business itself, stocks, bonds, real estate, or other financial instruments. Retirement planning. As a small business owner, it's essential to plan for your retirement. Options may include individual retirement accounts, IRAs, simplified employee pension, SEP, plans, or 401k plans, among others. Tax planning. Small business owners should optimize their tax strategy to minimize tax liabilities legally. Understanding tax deductions, credits, and benefits available to businesses can significantly impact the company's bottom line. Insurance coverage. Adequate insurance coverage protects the business from potential risks and liabilities. Common types of insurance for small businesses include general liability insurance, property insurance, professional liability insurance, and workers' compensation insurance. Diversification of investments. Asset allocation. Instead of investing all available funds in a single investment, diversification encourages allocating investments across various asset classes such as stocks, bonds, real estate, mutual funds, and commodities. Different asset classes have varying risk profiles, and their performance can be influenced by different economic factors. Industry and sector diversification. Within each asset class, consider investing in different industries and sectors. Economic conditions can affect industries differently, so spreading investments across various sectors can help balance the portfolio's overall performance. Geographic diversification. Expanding investments internationally can help reduce risks associated with country-specific economic or political events. Investing in multiple countries can provide exposure to different markets and economic cycles. Risk tolerance. Diversification allows tailoring the investment portfolio to match the risk tolerance of the business owner. More risk-averse investors may prefer a balanced and diversified portfolio, while others may be willing to take on higher risk for potentially higher returns. Long-term growth. Diversified investments generally offer more stable growth over the long term. While individual assets or sectors may experience volatility, a well-diversified portfolio can withstand market fluctuations. Diversification of revenue streams. Product and service mix. Offer a diverse range of products or services to appeal to a broader customer base. Relying heavily on a single product or service can leave the business vulnerable if demand for that specific offering declines. Customer segments. Target multiple customer segments to avoid excessive dependence on a particular group. Market shifts or changes in customer preferences could impact one segment differently from others. Sales channels. Diversify sales channels, such as online platforms, brick-and-mortar stores, and partnerships with other businesses. A multi-channel approach can help reach a wider audience and reduce the risk of relying solely on one distribution method. Geographic markets. Expanding into new geographic markets can protect the business from local economic downturns or regional challenges. Recurring revenue models. Implement subscription-based or recurring revenue models, if applicable to the business, to create a more stable and predictable income stream. By diversifying investments and revenue streams, small business owners can reduce the impact of adverse events in specific areas and enhance overall financial stability. However, it's important to strike a balance between diversification and focus to ensure that resources are efficiently allocated to achieve business objectives. Regularly assess the effectiveness of diversification strategies and adjust as needed to align with changing market conditions and business goals. Seek professional advice. If financial matters seem complex or overwhelming, it's wise to seek guidance from financial advisors, accountants, or business consultants. These professionals can provide tailored advice and help small business owners navigate through various financial challenges. Remember that financial planning is an ongoing process. It requires regular review and adjustments as the business evolves, the market changes, and economic conditions fluctuate. A solid financial plan provides a roadmap to guide the business towards long-term success and sustainability.